Hey everyone, welcome back to Corporate Decoder, the place where we decode the language your accountant calls English. Today we are diving into a filing by Xsolla SPAC 1, and let me tell you there are more red flags and moving parts here than a one-way ticket to a black hole. Stick around to see if this is a cosmic bargain or a black hole for your cash. Before we start, if you appreciate us wading through these mountainous filings to bring you the raw, unvarnished truth about corporate finance, make sure you are subscribed. And hey, if you want to keep the conversation going and connect with other finance fanatics, our Discord community is linked down below, so hop in. So, Xsolla SPAC 1 is back with an SEC filing dated the 12th of January 2026. Now, SPACs, or Special Purpose Acquisition Companies, are basically shell companies created to raise money through an IPO with the sole purpose of acquiring an unidentified company. Think of it as a blind date for your money in the corporate world. This is an amendment to their S-1 registration statement, meaning they're updating their initial public offering plans. They are offering 25 million units at $10 a pop, aiming to raise a cool $250 million. But wait, there is more. They also have an option to sell an additional 3.75 million units, potentially bringing in another $37.5 million. So, we are looking at a potential total raise of over $287 million. The company itself, Xsolla SPAC 1, is incorporated in the Cayman Islands. And get this, they've only been around since last year, September 2025. That is a blink of an eye in corporate terms. They have no operating history, no revenue, just a plan to find a business to merge with. Now, this Cayman Islands incorporation isn't just for show. It often comes with tax advantages, which is something to keep an eye on. Their principal executive offices are located in Sherman Oaks, California. Interestingly, even though they are a Cayman Islands company, their operational base seems to be here in the US. They are registered with the SEC under number 333 to 290,802, which is a standard identifier for these filings. This is amendment number 2 to their Form S-1. It means they've already filed and updated their initial paperwork. They are likely refining their strategy, addressing SEC comments, or providing updated financial information. The fact that it is an amendment suggests they are serious about moving forward. See this checked box here. It indicates they are utilizing Rule 415 for continuous offerings. This is common for SPACs as they might issue securities over time rather than all at once. Now, this is crucial. They explicitly state that investors are not getting the protections normally afforded to investors in Rule 419 blank check offerings. This means fewer restrictions on how and when the money is handled, and potentially less investor protection. They also remind us that investing in their securities comes with significant risks. Good to know, right? Here is the core offer, 25 million units. Each unit is priced at $10 and it is a package deal. You get one Class A ordinary share and 1/3 of a warrant. Now that 1/3 warrant is interesting. It means you need 3 warrants to buy 1 share. This is a strategy some SPACs use to reduce the dilutive effect of warrants, making them potentially more attractive to target companies. For each whole warrant, you can buy 1 Class A ordinary share for $11.5. This is the shareholder's lifeline. Upon their initial business combination, public shareholders get the chance to cash out their shares for the amount in the trust account. This is a key protection for investors in SPACs. They get their money back plus any interest earned if they don't like the deal. They have a ticking clock 24 months to find and merge with a company. If they don't, the money in the trust account is returned to shareholders and the company essentially dissolves. This creates urgency but also pressure, which can lead to bad decisions. Before this offering, there was no public market for anything they are selling. This is typical for SPAC IPOs. They intend to list on the NASDAQ under the ticker symbol XSLU. They are also identifying as an emerging growth company and a smaller reporting company. This means they get to follow some relaxed reporting rules, which can lead to less transparency for investors. Basically, they get to take some shortcuts. Let's look at the numbers. The price per unit is $10. Total proceeds to us before expenses are $9.925 per unit, after underwriting discounts and commissions. That means about 7.5 cents per unit goes to the underwriters. Not bad for selling shares. So the bulk of the money raised, a massive $250 million, is going straight into a trust account. This is the investor protection money. It can only be used for the business combination or returned to shareholders if the deal falls through. Now let's talk about the sponsor. Xsolla SPAC ILC holds 9.58 million founder shares. These are shares they got for a ridiculously low price, like pennies. This is where the potential for massive profit for the sponsor comes in. And for you, the public investor, it means immediate and substantial dilution. This is a classic SPAC structure. The sponsor brings the deal, gets cheap shares, and hopes it pays off big time. Here is another interesting tidbit. The sponsor might loan them money for transaction costs, and that loan could be converted into units of the future company at $10 a piece. This is another way the sponsor can get more equity for their loans, potentially at a discount. This table is crucial for understanding dilution. Look at the dilution to public shareholders row. Even with full exercise of the overallotment option, the dilution is a staggering 98% in the maximum redemption scenario. This means if many shareholders cash out, the value of the remaining shares for those who stay in could be next to nothing. That is a huge warning sign. This section is standard boilerplate in SEC filings, basically saying, don't hold us responsible if things go wrong with our future plans. They are forecasting their expectations, hopes, and beliefs about the future. Most of these statements are couched in terms of may, potential, and expect, which are all good indicators that these are educated guesses, not guarantees. This is where they lay out all the ways this investment could go south. We'll hit the highlights. This is a big one. Their own auditors are saying there is serious doubt about their ability to keep the lights on. This is usually due to a lack of operating history and significant costs associated with their search for a business. They are relying on this IPO to fix that, but it is a red flag. Here is a potential conflict of interest. The initial shareholders who got their shares for dirt cheap are agreeing to vote for the business combination. This means they can push through a deal even if most public shareholders don't like it. This is because they have more to lose if the deal doesn't happen at all. Scroll the nominal purchase price paid by our sponsor for the founder shares may significantly dilute the implied value of your public shares in the event we consummate an initial business combination. Scroll, this is the dilution point we saw in the table. The sponsor bought shares for practically free and is expected to make a huge profit. Even if the deal tanks the stock price, this can incentivize them to find any deal rather than the best deal. There is also the risk that their shares could be delisted from the Nasdaq. This would make it much harder to trade them, and they could end up on an over-the-counter market, which is generally much less liquid and more speculative. The money in the trust account isn't just sitting there. It is invested in very safe, short-term US government securities or money market funds. This is to ensure the money is there when needed, but it also means the returns will be minimal. Let's talk about where the money from this offering is going. Out of the $255 million potential total gross proceeds, about $1.4 million is going to cover offering expenses like legal fees and printing. The underwriting discount is another $1.875 million. This leaves about $248 million in proceeds to us after estimated offering expenses. Of this, a whopping $250 million goes into that trust account we mentioned earlier. The remaining roughly $1.7 million is for general operations and finding that business to combine with. They've budgeted $400,000 for legal fees related to finding and closing a business combination. That is a significant chunk for just legal work, highlighting the complexity and cost involved in these deals. This section is pure gold for anyone considering this investment. It spells out exactly how much your investment could be worth less than what you paid for it due to dilution. As we saw earlier in the maximum redemption scenario, the dilution to public shareholders can reach a staggering 98.40%. This means for every dollar you invest, potentially only a few cents are truly yours after all the sponsor shares, warrants, and potential redemptions are factored in. That is a very aggressive dilution figure. This table shows how the company's financial structure changes after this offering. You can see the significant impact of the Class A ordinary shares subject to possible redemption, which is essentially the money in the trust account, totaling $250 million. This highlights how much of the company's capitalization is tied up in that trust account, waiting for a business combination. Scroll management's discussion and analysis of financial condition and results of operations. Scroll, this is where management talks about their financial status. They acknowledge having no operating history and no revenues. Their liquidity needs are met by the IPO proceeds and loans from their sponsor. They're essentially saying they're broke right now and need this IPO money to survive and find a target. Scroll checks and balances designed to prevent conflicts of interest. Or so they say. Scroll, they talk a lot about how they are trying to avoid conflicts of interest, especially with their sponsor and management team. They have independent directors, committees like audit and compensation committees, and a code of ethics. However, the sheer amount of disclosure around conflicts suggests these are very real concerns. It is like saying, we promise not to steal, but here are all the rules about stealing. Scroll collective multifaceted expertise, investing and operating experience, and broad network of relationships to source and evaluate potential transactions and create value for our stakeholders. Scroll now for the story they're trying to sell. They've assembled this crack team with vast experience in M&A. capital raising, and operations across various sectors. They boast about their extensive network, especially their connection to Xsolla, a global leader in game commerce. They believe this expertise and network will help them find and successfully merge with a high-quality target. Scroll risks relating to our sponsor and management team. Scroll, this section is all about the sponsor and management, and it is a juicy read. Scroll, the nominal purchase price paid by our sponsor for the founder shares may significantly dilute the implied value of your public shares in the event we consummate an initial business combination. Scroll, they hammer home the point that the sponsor's cheap founder shares can lead to massive dilution for public shareholders. The sponsor paid about $0.0026 per S-hair, while we're paying $10. That is a 400,000% markup. This difference can incentivize the sponsor to prioritize closing any deal, even a potentially bad one, just to realize their profit. Scroller public shareholders may not be afforded an opportunity to vote on our proposed initial business combination, which means we may complete our initial business combination even though a majority of our public shareholders do not support such a combination. Scroll, another critical risk, they might not even let you vote on the final deal. They can proceed with the business combination using a tender offer instead of a shareholder vote. So even if you hate the proposed merger, you might have no say in it. Your only recourse could be to redeem your shares. Scroll, changes in laws or regulations or a failure to comply with any laws and regulations may adversely affect our business, including our ability to negotiate and complete our initial business combination and results of operations. Scroll, they are subject to a constantly changing legal landscape, including new SEC rules for SPACs. These regulations can significantly increase costs, complexity, and time required to complete a deal, potentially derailing their plans. Scroll, Xsolla SPAC 1 balance sheet, the 19th of September 2025. Scroll. Let's peek at the actual financials, albeit very early ones. As of the 19th of September 2025, Xsolla SPAC 1 had total assets of just $75,000, mostly in prepaid and deferred offering costs. Their liabilities were $70,912, mainly from accrued expenses and this promissory note to their related party, the sponsor. That leaves a shareholder's equity of a measly $4,088. This is a company that exists on paper, waiting for money from this IPO to do anything. They also have this over-allotment liability of $311,300 in there as adjusted column. This refers to shares they might have to buy back if the underwriters sell more than they initially planned. Scroll, report of independent registered public accounting firm Scroll, their auditors. Malone Bailey LLP flagged a significant going concern matter. They explicitly state there is substantial doubt about its ability to continue as a going concern. This is a direct warning that the company might not survive without the IPO proceeds from this offering. Scroll formation general. And administrative costs $20,912, says Scroll, for the period from inception in mid-September 2025 to the end of that week. Their entire operating cost was a mere $20,912. Essentially just formation and general administrative expenses. It is pocket change for a company in this stage. Scroll, because we are incorporated under the laws of the Cayman Islands. You may face difficulties in protecting your interests, and your ability to protect your rights through the US federal courts may be limited. Scroll, here is another risk. Being a Cayman Islands company means legal recourse for us investors can be complicated and less protective. Enforcing judgments against directors or officers residing outside the US can be very challenging. Scroll, principal shareholders. Scroll, this table shows who owns what before the offering, the sponsor. Xsolla SPAC LLC owns nearly all the shares. After the offering, their stake significantly decreases, but they still wield considerable influence due to their founder shares and board appointment rights. Scroll, Xsolla SPAC LLC 3, 8758330 shares beneficially own TWO. Scroll, before the IPO, the sponsor holds 8.7 million shares, about 91.4%. After the IPO, assuming no over-allotment, that drops to about 8 million shares, still a significant 23.7%. But remember, these are founder shares, bought for pennies, and they have special conversion and voting rights. Scroller sponsor paid an aggregate of $25,000, or approximately $0.0026 per founder share, and accordingly you will experience immediate and substantial dilution from the purchase of our Class B ordinary shares. Scroll, they don't shy away from stating that you, the public investor, will experience immediate and substantial dilution from the sponsor's cheap founder shares. It is a direct acknowledgement of the uneven playing field. Scroller amended and restated memorandum and articles of association provide that unless we consent in writing to the selection of an alternative forum, The courts of the Cayman Islands shall have exclusive jurisdiction over any claim or dispute arising out of or in connection with our amended and restated memorandum and articles of association, or otherwise related in any way to each shareholders. Shareholding in US Scroll. This is a big one for legal disputes. They are mandating that any legal battles between shareholders and the company will be fought in the Cayman Islands courts. This could be a significant hurdle for us investors trying to seek justice. Scroll conclusion, scroll so. What is the verdict on Xsolla SPAC 1's filing? This is a classic SPAC play. They've raised a significant amount of money, much of which is locked in trust, and they have a tight deadline to find a business. The sponsor and management team have extensive experience, but the nominal price paid for founder shares means there is a massive potential for dilution and inherent conflicts of interest. The going concern warning from their auditors is a serious red flag, and the limited investor protections, especially regarding voting rights and the exclusive Cayman Islands Forum for disputes, add to the risk profile. The story here is about the sponsor's gamble. They are betting on their network and expertise to find a deal that pays off handsomely for them, even at the cost of significant dilution for public investors. The risks are numerous, from failing to find a deal to the potential for subpar target selection driven by the sponsor's profit motive. For Xsolla SPAC 1, the jury is definitely out. They have the capital and the plan. But the existing structure and the warnings in the filing suggest caution is paramount. This investment is a bet on management executing a near-perfect deal within 2 years, which is a tall order in any market. Alright, that is our deep dive into Xsolla SPAC 1 filing. What is your take on this SPAC strategy and these numbers? Do you think they'll find a winning business combination, or is this just another cautionary tale? Drop your thoughts in the comments below if this analysis was valuable. Hitting that like button really helps us out, and more importantly, subscribe for more breakdowns of corporate documents. And hey, if you want to continue the conversation, join our Discord community linked in the description below. Thanks for watching, and see you next time on Corporate Decoder.